You think your bank is just behind the times, old school, a little slow as technology is what they actually are. A highly optimized profit machine designed to extract maximum fees from people who can least afford them. That overdraft fee isn't an accident, it's the business model. Everyone says banks are essential. You need somewhere safe to keep your money. You need direct deposit for your job. You need a debit card to function in modern society. And they're right about that part. What they don't tell you is that traditional banks have spent decades engineering every possible way to profit from your mistakes, your emergencies, and your ignorance. They've turned basic banking into a minefield where one wrong step costs you $35. Your parents probably told you to just pick a big trusted bank. Bank of America, Wells Fargo, Chase, the names everyone knows. They said build a relationship with them, they'll take care of you. Your first job's HR department handed you paperwork for direct deposit and probably suggested their preferred bank. It felt official, professional, like you were doing the adult thing. The banker smiled, gave you a free pen, explained you need to maintain a minimum balance. You nodded. Seemed reasonable. Here's the reality they don't explain during that friendly account opening. The average American pays about $294 per year in bank fees, not interest on loans, not credit card fees, just fees for having a checking account. Overdraft fees, monthly maintenance fees, ATM fees, minimum balance fees, wire transfer fees, paper statement fees, fees for calling customer service too many times, fees that hit hardest when you're already struggling. Let's break down the overdraft trap specifically because it's their biggest moneymaker. You've got $42 in your checking account. You forget, and you buy a $12 lunch. The bank doesn't decline the transaction, they approve it. They pay the $12 on your behalf, and then they charge you $35 for the privilege. Your $12 sandwich just costs you $47. But it gets worse. You have 3 more small purchases that same day: a coffee, some gas, a grocery run. Each one triggers another $35 fee because the bank processes them after your account is already negative. 4 transactions, $140 in fees, all in one day, for someone who was $30 short. The brutal math gets worse over time. Americans paid about $8 billion in overdraft fees in 2024 alone. Not $8 billion in emergency loans they chose to take out. $8 billion in penalties for being broke. The people paying these fees aren't rich people who forgot to transfer money from savings. 68% of overdraft fees are paid by just 9% of account holders. The same people, over and over. People living paycheck to paycheck who can't afford the fee, which makes them more likely to overdraft again next week. Your bank also reorders your transactions to maximize fees. You make 5 small purchases throughout the day and 1 big purchase. They process the big one first, draining your account, then process the small ones. Instead of 1 overdraft fee, you get 5. Courts have ruled this is legal. They call it a business practice. You call it a scam if anyone else did it. Then there's the minimum balance requirement. Your bank says you need to maintain $1,500 in checking, or they charge you a $12 monthly fee. Sounds simple enough, but think about what that actually means. $1,500 sitting in an account earning 0.01% interest, that's 15 cents per year. Meanwhile, inflation is running at 3 to 4%. Your $1,500 loses about $50 of purchasing power every year just sitting there. You're paying an invisible fee to avoid a visible fee. And if you're someone who actually needs that $1,500 to pay rent or fix your car, you pay the $12 monthly fee instead. $144 per year just to have a checking account. ATM fees are another quiet bleed. Your bank has 3,000 ATMs nationwide. Sounds like a lot. Until you need cash, and the nearest one is 40 minutes away. So you use the ATM at the gas station. That ATM charges you $3. Your bank charges you another $3 for using an out-of-network ATM, $6 to access your own money. If you do that twice a month, that's another $144 per year. You're paying almost $300 annually just to access money you already earned. The psychology behind why people stick with these banks is fascinating and depressing. First, there's inertia. Switching banks feels complicated. You've got direct deposit set up, auto pays for your utilities, your rent check. The thought of changing all of that while you're already stressed about money feels overwhelming. So you stay. The bank knows this. They've studied it. The average American keeps the same checking account for 16 years. Longer than most marriages. Second, there's brand trust. These banks have marble lobbies and Super Bowl commercials and 100-year histories. They feel permanent, safe. The FDIC-insured sticker on the door makes you feel protected, and you are protected from the bank failing. You're not protected from the bank systematically charging you fees that make it harder to build wealth. Those are two very different things. Third, there's the illusion of relationship. Your bank says they value you as a customer. They have a local branch where someone knows your name. They send you a birthday card once. This feels personal. But look at their profit reports. Wells Fargo made over $20 billion in profit in 2024. A significant chunk came from fees on people making under $40,000 per year. That's not a relationship. That's extraction. Fourth, there's financial shame. You overdraft your account. You feel stupid, irresponsible, like you failed at basic adulting, so you don't talk about it. You don't research alternatives. You just try harder to avoid fees next time. Except next time you have a medical bill or your car breaks down, and it happens again. The shame keeps you isolated and uninformed. Exactly where the bank wants you. Here's the part that should make you angry. There are better options. Right now, available to almost everyone, and the traditional banks have spent millions in lobbying to make sure you don't know about them or don't trust them. Credit unions are the first alternative. They're not for profit. That doesn't mean they're charities. It means they're owned by their members, you. When a credit union makes money, it goes back to members through better interest rates and lower fees. The average credit union charges about $16 per year in fees. Remember, traditional banks average $294. That's $278 you're leaving on the table every single year by staying with a big bank. Credit unions typically offer free checking accounts with no minimum balance requirements, free ATM access through shared networks that give you access to more ATMs than most big banks, lower overdraft fees, usually around $25 instead of $35, and many credit unions offer overdraft protection that transfers from savings for free or declines the transaction instead of charging you $47 for a sandwich. The objection people raise is that credit unions are small and inconvenient. Some are, many aren't. Navy Federal Credit Union has over 13 million members. That's bigger than many regional banks. And even smaller credit unions participate in shared branching networks, where you can walk into thousands of other credit union locations and do your banking. The technology argument died 10 years ago. Most credit unions have apps that work just as well as Chase's app. Online banks are the second alternative. Ally Bank, Chime, Discover, Capital One 360. These banks have no physical branches, which means lower overhead, which means they can offer better terms. No monthly fees, no minimum balances, higher interest rates on savings. Actual interest rates barely pays around 4% on savings accounts right now. Your traditional bank pays 0.01% on $10,000. That's the difference between $400 and $1 per year. Chime specifically has built their entire business model around not charging overdraft fees. They offer SpotMe, which covers you up to $200 with no fee, not low fee. No fee, because their business model is based on interchange fees from merchants when you swipe your card, not on punishing you for being broke. They make money when you use the card successfully, so they're incentivized to help you avoid overdrafts, not cause them. The objection to online banks is usually about depositing cash. Fair point. If you're a server or bartender getting cash tips daily, online-only banking is harder. Though many online banks partner with retail locations for cash deposits now, but if 90% of your income is direct deposit and you rarely handle cash, that objection evaporates. Let's talk about who can actually afford to stay with a traditional bank. If you've got $20,000 sitting in checking and savings combined, earning real interest and getting fee waivers, and you never overdraft, and you use your bank's ATMs exclusively, and you're getting real value from a personal banker relationship that helps you with mortgages and business loans, then fine, stay. For you, the convenience might be worth it. That's maybe 5% of Americans. For everyone else, you're paying a poverty tax. You're subsidizing the bank's profit margins because switching feels hard, and I get it. When you're working 2 jobs and raising kids and barely sleeping, researching bank alternatives is low on your priority list. But this is one of those things where 3 hours of effort one Saturday saves you $3,000 over 10 years. That's $1,000 per hour. Show me another use of your time that pays that well. Here's how the math actually works. Take your current annual bank fees, add them up. Overdrafts, monthly fees, ATM fees, everything. Let's say it's $300 per year, you're 30 years old, you switch to a credit union or online bank with zero fees. You invest that $300 per year in a simple index fund, earning an average 8%. By the time you're 60, that's $34,000. You didn't earn more money, you didn't get a raise, you just stopped letting your bank quietly bleed you. But it's not just about the fees you pay, it's about the interest you don't earn. Traditional bank savings accounts pay essentially nothing. Online banks and credit unions pay 3 to 4% right now. If you keep a $3,000 emergency fund, that's the difference between $3 and $120 per year. Over 30 years invested, that gap becomes another $36,000. We're now at $70,000 of wealth you're giving up by staying with the predatory bank. The time horizon matters here. The younger you are, the more expensive your loyalty to a bad bank becomes. If you're 22, that same math extends to retirement at 67. 45 years of compounding, the fees and lost interest could easily top $150,000. You could trade a checking account for a paid-off house. That's the real price. Banks also know exactly when you're most vulnerable. They market aggressively to college students and young adults who don't know better yet. They offer a free t-shirt and a mini fridge to open an account. They make it seem normal to pay fees. By the time you realize you're being ripped off, you've got 10 years of auto pay set up and switching feels impossible. They count on that inertia. There's also the issue of banking deserts. In low-income neighborhoods, traditional bank branches have closed. What's left are check cashing stores and payday lenders that are even more predatory. People in these areas pay an average of over $500 per year just to access their own money. No bank account at all, just fees to cash paychecks and pay bills. This isn't an accident. Banks decided these customers weren't profitable enough, so they left. Now those communities pay more for less. The alternative isn't to stuff cash under your mattress. It's to be strategic about which institution gets to hold your money. A credit union that reinvests in your community. An online bank that pays you interest instead of charging you fees. Even a combination, checking at an online bank for day-to-day spending. Savings at a credit union for your emergency fund. You're allowed to use multiple institutions. You're allowed to optimize. The practical steps are simpler than you think. First, open the new account. Most online banks and credit unions let you do this in 15 minutes from your phone. You don't need to close your old account yet. Second, set up direct deposit to the new account. Your HR department does this all the time. It takes one email. Third, move your auto pays one by one over a few weeks. Start with the easy ones, Netflix, Spotify, your phone bill. Then do utilities and rent. Fourth, once everything is moved and you've confirmed 2 full pay cycles work smoothly, close the old account. Bam, go into the branch with zero balance and close it in person so they can't hit you with one last fee. The whole process takes maybe 4 hours of actual work spread over a month. You're not doing it all at once. You're doing it in small pieces while watching TV or on your lunch break. And the result is you stop paying $300 per year to a corporation that doesn't care about you. Here's what I want you to understand. Your bank isn't neutral. They're not just storing your money as a favor. They're a business optimized to extract maximum profit from your financial mistakes and your lack of knowledge. Every fee is intentional. Every confusing term in the fine print is intentional. The order they process transactions is intentional. They've hired teams of PhDs in behavioral economics to figure out exactly how to get you to overdraft more often. This isn't about being anti-bank. It's about being pro-you. Banks serve a purpose. They provide loans. They facilitate transactions. They're parts of the infrastructure of modern life, but you should use them like you use any other service. Get the best deal, pay the least amount, extract maximum value for yourself. Loyalty to a bank that charges you $35 for being $12 short is misplaced loyalty. The next time you get hit with an overdraft fee, don't just feel bad about yourself. Get angry at the system designed to kick you while you're down. Then do something about it. Open your phone right now. Search for credit unions in your area. Search for Ally Bank, Chime. Discover online banking. Read reviews. Compare fee schedules. Most have 0 monthly fees, 0 overdraft fees, and actual interest on savings. You're not stuck. You just thought you were. The bank spent decades convincing you that switching is hard and that all banks are basically the same. Neither is true. Switching takes one weekend, and the difference between a predatory bank and a member-focused credit union is literally tens of thousands of dollars over your lifetime. Here's the real question. Are you willing to spend 3 hours this month to save $3,000 over the next decade? Because that's the trade. Your bank is betting you'll say no. They're betting on your inertia, your shame, your busy schedule, and your assumption that this is just how banking works. Prove them wrong. Your bank isn't old school. They're not slow to adapt. They're not your friend who's a little out of touch with technology. They're a finely tuned machine built to profit from your poverty. Treat them accordingly. Take your money somewhere that treats you like a member, not a revenue stream. Future you, the one who's not paying $300 a year in fees, will thank you.